Hey traders, welcome. So in this series of videos talking about technical, specifically chart patterns, and in this video we are talking about the rounded bottom pattern. Yes, the rounded bottom pattern. Okay, now let's look as usual as we do at the textbook definition. Then I'll talk about exactly how I think it works from a supply demand perspective, because that's how I like to look at trading. If you've got a way of trading this pattern, or if you think it works or doesn't work, leave a comment below. Would love to hear how you trade it or don't trade it. If you've got a little twist or a little flavor on it as well that works for you, then let me know, because I love to hear those kind of things. So, definition of rounding bottom. It is a U-shape chart which forms at the bottom of a trend, of an extended trend, and signifies, a reversal in long-term price movements. That's the textbook. Let's have a look. Let's drill down into it and see exactly what it's all about. So, the rounding bottom pattern. I'm going to try and draw this here. Let me just see if we can get a good one of this. So, this is over kind of weeks or months. This is really, I'm being very kind of, hopefully you can get that. I think that's not too bad. Put it in perspective. But anyway, right, this is kind of what it's all about. Let's get a pen here. So this is the shape we're looking for, really. It's this U-shaped bottom. And it really, if you think about it in perspective of, what it means for traders, what it means for traders on one side or the other of the market. You're in an extended downtrend. And as always, with any of these patterns, it's the point of view is where it occurs. If this occurs in chop in a weekly range and you get this, discard it, a waste of time. If the market's been moving down for weeks or months or whatever it is, or if you're day trading for hours, then by all means, this makes much more sense. Again, it's about using the right tool for the right job, putting in the right perspective. So let's go back to the rounding bottom pattern. The point is that you get it, it comes down, price is kind of just chugging lower, and at some point, it just changes sentiment a little bit. Now, I know this is a little bit structured and I've kind of gone, you could probably draw a trend line there. In reality, it would be a little bit more grainy. Let's have a look at the example they've used, and I might show you this if I can. It's a similar kind of thing, really. If you can see that, guys, that's what I'm looking at there. Just from a standard stockcharts.com. I just want to see what the textbooks say about it, and then we'll kind of see how we put our flavor on it. So the point is, at some point, things start to change. The bears run out of steam, they run out of enthusiasm for the market. They don't really want to sell it lower, they're not that interested. Buyers, again, aren't that aggressive. It's not as if they're stepping in and going poof and rocketing the thing straight up. It's a steady, slow change of the seesaw. So you've got the bears in control, you kind of get to this level here, equilibrium, and then it sort of settles. So it's a little bit more of a smoother pattern. So as we come down here, you've got bears backing off, and this kind of point here, this is obviously going to be different for the market. You might have a bit of a spike lower, a bit of a spike higher. The point is that you're rounding it and you're averaging it out, and you're kind of getting a bit more of a smoother look of it. But the area here is where the buyers are saying, you know what, this is actually good value now. It's at a much lower point. I perceive this as good value. Sellers are thinking, I don't really want to sell it any lower. That combined together is giving you a point where it's kind of meeting an equilibrium ground. Everyone's happy. It's not doing much. You get this kind of level at the bottom here. And then eventually, over a period of time, this is much more of a swing trading pattern, I believe, than the day trading pattern, is that eventually over time you kind of the trend changes, the seesaw changes, and buyers come back into control. So it's just finding that pinnacle point. Now the idea in trading is that as soon as you spot that, you get involved in the long side, and because it's a swing trading strategy, you can afford to kind of have your stop under the low here and look for complete change in reversal, i.e. many months, many years, whatever it may be. That makes sense. The volatility dries off a little bit as well. It kind of, it's almost like the end of it, the last thing. It's not exhaustion as in a real flurry of volume, as you often get. You see that big spike and big exhaustion candle to the downside. It's more a case of it's just run out of puff. It's just run out of puff. And then ultimately, bulls perceive it as value. You might even have something in here, some sort of catalyst. Catalyst, I think I've spelled that right. No, I haven't. It is catalyst. There we go. You might have some kind of catalyst there that means that this is going to move back up, or means it's going to change direction a little bit. It's not a, I don't think, it says there it's a really great pattern. In the textbook it says it's a really great pattern. If you agree with that, then let me know. If you think this is a really, really good pattern, then please, you know, let me know. I'm not a huge fan of this, perhaps because I'm more of a shorter term trader, and I find this as low volume is a little bit of a nemesis for me, so I'm a little bit cautious of it. But from a swing trading perspective, it does make a lot of sense. Let me know if you use this, if you look out for this, if you scan for this in your swing trading. If you like this video, give it a thumbs up. If you want to see more videos like this, technicals, strategy, discipline, psychology, subscribe, because I'm back with a load more videos coming up this week, this month, the next few months from me. Good trading, guys. Manage the risk. Take care.